Hey guys, this video will focus on the features of the tax system. Now, there are three major features that we'll look at concerning the tax system in this video. We're going to look at 1. The tax mix, 2. The tax base, and 3. The tax burden. Now these are important, or 3 of the most important features of the tax system that we need to understand. Okay, so let's look at the tax mix to start off with. I'll just denote this 1. So the tax mix refers to the balance between direct and indirect taxes the government levies. So it refers to the balance of direct and indirect taxes levied by the government. So what this means is that the government has to choose a balance between direct taxation and indirect taxation to fund its revenue. So at the moment, around 94% of all federal revenue are derived from taxation, of which around 62% comes from direct taxation. So 64%, or 62% I should say, is from direct taxation, and just over 26% from indirect taxation. So the government needs to weigh up the choices of how to levy direct and indirect taxes so that their revenue can be maximized. Because with more revenue, they could have more scope in order to manage aggregate demand so as to achieve the government economic goals. So the other 6% to balance at the taxation is from non-tax revenue by the government. Okay, so that's the tax mix. So now we'll look at the tax base. And this is another important concept when referring to revenue, because the government wants to tax as many people as they possibly can in order to increase their revenue here. So the tax base refers to how broadly the particular taxes apply. So it refers to how broadly a particular tax is applied. So for example, the income tax, or the tax base of income tax, personal income tax, is applied to everyone who earns income over $18,200. So the income tax, the base is everyone with income earned over $18,200 in a financial year. Again, if you have the GST, this is applied to people who purchase specific goods and services, which can be taxed under the goods and services tax. And again, we have a company tax. They're levied on companies. So that refers to the tax base. The wider the tax base, the more revenue the government could acquire. And lastly, we have what is known as the tax burden. And now the tax burden relates to the rates of direct and indirect tax applied. So it refers to the rates of tax applied. And as the name suggests, refers to who bears the burden of taxation. So we can look at this in 2 ways. We can look at tax burden either in 1, direct taxation, or 2, indirect taxation. So direct taxation, the tax burden is fairly obvious. It is applied for income tax on households and on company tax on businesses. So that's fairly straightforward. But indirect taxation, that can be a little bit trickier. So we're going to look at an example of how tax burden can affect an indirect taxation. I'm just going to rub this out here. And we're going to look at how a tax or indirect tax, for example, say a tobacco tax or an excise duty tax, we'll see, depending on the relative elasticity of demand and supply, the tax will be borne on either the supplier or the consumer. So as we know, we're going to look at this with the example of a relatively inelastic supply curve. So producers can't change their supply in the short run. We have a relatively demand proportional or unit elastic demand curve for simplicity. So as we can see, the equilibrium price is at P1. The equilibrium quantity traded is at Q1. That's given simple demand supply analysis. But if the taxation is here, denoted by the white brackets, that is the rate of tax, we can see that the equilibrium price supplied at, or what the suppliers get, is at PTS. I'm going to call that P tax on the suppliers, and the price that at which the consumers buy it at is at PTD. So what this means is that, as you can see from the graph, the majority of the burden of the tax is borne by those supplying, I should say, because the suppliers are losing this much money. So let's say, for example, P1 is at $10, P2 is at $12, and PTS is at $4. We can see that the suppliers, after the excise duty tax, lose $6 worth of revenue, whereas those consuming it will only need to pay an extra $2 worth in tax. So the taxation revenue for the government here will be $8. So the suppliers in this case would bear the majority of what is known as the tax burden. If we look at another example where an indirect tax is applied to a market where the demand for that product is relatively inelastic, so say for example the market on tobacco, we can see that the demand curve is relatively steep. And we're going to call the supply curve relatively unit elastic again. And the same analysis could be applied. Before taxation, the equilibrium price was at P1 and the equilibrium quantity was at Q1. But with taxation applied, we can see that the price suppliers need to pay now hasn't changed a lot. This is only at, say, P dash. But the price that consumers need to pay has increased from P dash, P1 to P D dash dash. I want to call that. So the new price, those consumers need to pay for cigarettes is at this new price here, PD dash, whereas those supplier would only receive money at P dash, and the taxation in this case will be the difference between PD dash minus P dash. So as we can see in this case, where the demand is relatively inelastic, we can see that because the demand is inelastic, regardless of the price, consumers would still tend to purchase that good or service. And so this markup here above the market equilibrium price refers to the tax burden borne by the consumers, and the difference between the selling price or the market selling price at P1 and the actual selling price after taxation at P dash is the tax burden borne by the suppliers. So depending on the relative elasticity, the tax burden will will lead to different burdens borne by either suppliers or consumers. So they're the three major features of our tax system: the tax mix, the tax base, and the tax burden.